There is a specific fantasy we all have about quitting a corporate job. You walk out the door, set your own hours, and suddenly your hourly rate jumps by 20 or 30%. Then the following April rolls around. You file your return, and instead of a refund, you're staring at a tax bill that drains your savings account. When you work a standard W-2 job, your employer handles the heavy lifting behind the scenes. They calculate what you owe, pull those taxes out of every paycheck, and send them to the government before the money ever hits your bank account. As an independent contractor, you get the entire gross amount of your invoice paid directly. But in exchange, nobody is withholding anything. You are completely on your own for tax administration. Accepting a 1099 contract makes you the owner of a business entity. You assume every legal and financial liability once managed by an employer's payroll department. The biggest shock to the system comes from how the IRS handles Medicare and Social Security. Together, these are known as FICA taxes. This table shows the FICA breakdown for someone making $80,000 a year. Under a W-2, that tax is 15.3%, but you only pay half of it, 7.65%. Your employer quietly pays the other half out of their own pocket. On a 1099, there is no employer. You're both the employer and the employee. That means you pay the full 15.3% self-employment tax entirely by yourself. Look at what that means in raw dollars. On that exact same $80,000 salary, the 1099 contractor pays $5,184 more in upfront taxes. Keep in mind, that extra $5,000 is strictly the self-employment portion. You still have to pay standard federal and state income taxes on top of it. If a company offers to convert your W-2 salary to a 1099 contract at the exact same pay rate, they aren't doing you a favor. You are accepting a mathematically guaranteed pay cut. Sometimes, companies use 1099 contracts to dodge their side of the tax bill for jobs that are actually traditional roles. The IRS does not care what your contract says. They use a strict set of common law rules to determine your legal classification based on the reality of your working relationship. This decision tree illustrates how the IRS tests for control. First, behavioral control. Does the client dictate when and where you work, or your exact sequence of tasks? Next, financial control. Are you forbidden from taking other clients or protected from financial loss? If the client holds the reins on your behavior and your finances, the IRS considers you an employee, regardless of the 1099 label. Workers caught in this misclassification trap end up illegally subsidizing their employer's taxes while receiving absolutely none of the standard protections like health insurance or paid time off. If you are operating as a legitimate freelancer, you have a completely different problem to solve, managing inconsistent cash flow without a payroll department. Because nobody is withholding your taxes, the IRS requires you to estimate what you owe and send them payments 4 times a year. You have to hit deadlines in April, June, September, and January. To avoid underpayment penalties, you can use the safe harbor rule by paying at least 100% of your prior year's tax liability. Hitting those targets requires strict discipline. Every time an invoice gets paid, you have to instantly carve out 25 to 30% and lock it away in a separate account. A traditional paycheck does this invisibly. You never see the money, so you never have the temptation to spend it. If you treat your gross invoice as your actual take-home pay and miss those quarterly deadlines, you will quickly compound your tax bill with steep IRS penalties and mounting interest debt. To make 1099 work financially viable, you have to aggressively utilize the business deduction framework. You can write off the ordinary and necessary costs of running your business. That means deducting your home office space, equipment, software subscriptions, and tracking your business mileage. This chart visualizes how those deductions protect earnings. Under the 2025 One Big Beautiful Bill Act, the 20% qualified business income deduction is now permanent. Self-employed workers can also deduct their health insurance premiums. Stacking these write-offs directly reduces the income subject to tax. Building this shield takes continuous work. You have to save every receipt, categorize every expense, and manage your accounting software every single month. Pragmatic, tax deductions are not free money. You are trading your personal time and administrative effort in exchange for a lower effective tax rate. For high-earning contractors, the most powerful tax shields are high-limit retirement vehicles. Take a solo 401k. Because you act as both the business owner and the worker, you can make dual contributions, pushing tens of thousands of dollars out of your taxable income bracket. Beginning in July 2026, the law allows you to open a Trump account for a child under 18. As the employer, you can contribute up to $2,500 a year toward a $5,000 annual contribution limit. There is a distinct cost to the strategy. Every dollar you push into a retirement account to avoid taxes today is a dollar you cannot spend tomorrow. These accounts offer significant tax reductions because of their high contribution caps, but they legally lock away the liquid cash you might need to cover rent or expenses during a slow month. Taking on 1099 work does not automatically guarantee you will pay more in taxes. It simply shifts you from passive tax paying to active tax management. This matrix breaks down two operational profiles. The W-2 path is passive compliance. You accept lower earnings for predictable cash flow, benefits, and zero administrative friction. The 1099 optimizer requires high discipline, legitimate business expenses, and acting as your own chief financial officer. If you fit this profile, you can utilize specific deductions and retirement limits that are legally barred for traditional employees. You have to choose your trade-off. You either pay an employer with part of your potential earnings to handle the paperwork, or you maximize your take-home pay through rigorous financial discipline. When weighing an offer, you have to ask yourself one question. Do you just want to execute your trade, or do you want to run a business? The most dangerous place to be is stuck in the middle. You cannot afford to operate as a disorganized freelancer or let an employer misclassify you as a pseudo-employee. Signing a 1099 contract without a concrete plan to track expenses, manage quarterly payments, and maximize deductions is financially destructive. Look past the gross hourly rate. When you review your next contract, factor in the hours you will spend bookkeeping, the cost of your own insurance, and the weight of the self-employment tax. In the modern gig economy, financial autonomy is profitable for the disciplined optimizer. For the unprepared, the transition often leads to thousands of dollars lost to avoidable taxes and penalties.